Let's talk about conventional loans. So these are traditional conforming loans that are backed by Fannie and Freddie, traditionally assumed to be a more higher standard of financing. So when sellers are comparing offers, conventional loans are the type of loans that better, and that's not really a metric that we like to use in the mortgage, but more qualified clients will use. The down payment can range from anywhere from 3% as a first-time home buyer all the way up to 60 or 70% for the savvy investor. If you put less than 20% down, just like most other loan products, there is something called PMI or mortgage insurance. However, the big caveat with conventional loans is that this PMI will drop once you receive or reach that 20% equity in your home. Conventional loans are not assumable, so in this higher rate interest market, clients will ask if there's an assumable loan on the home, and unfortunately conventional loans or conventional financing is not assumable. So to summarize, conventional loans are the top tier quality of home financing. Sellers like these offers much more than government types of financing, and they are probably the most popular loan product that we offer. FHA loans are a government-backed loan product that is traditionally was created to help the not-so-savvy home buyer. So that would be lower down payment, sometimes no down payment, lower credit score, and the ability, sometimes didn't have the ability to save or have reserves is something else that FHA is a little bit more lenient on. Because of those pieces, it is sometimes considered higher risk financing, which would be a negative in this competitive market where sellers, if comparing different offers, had a conventional offer versus an FHA or other type of government-backed loan. They would typically prefer the conventional loan just because historically conventional loans have been a higher caliber of borrower. The down payment can range anywhere from zero down, because most grant programs will back their loan with an FHA loan product. So if you qualify for a first-time homebuyer grant or a state down payment assistance program, then the back end or the supporting loan will typically be an FHA loan. There is a fee to use the loan that is financed, so it is rolled into your loan, and at this current time it's at 1.75% of the loan amount. So it's called an upfront FHA mortgage insurance premium fee. Additionally, there is a monthly fee or mortgage insurance premium that is paid monthly. This mortgage insurance, unlike mortgage insurance for a conventional loan, does not drop at 20% equity in the home. However, so what I coach a lot of my clients to utilize FHA for is to get into a home, maybe with their credit not being as high or their down payment not being as high as they would prefer. And then as rates continue to drop, typically refinance out of that product into a conventional loan so that when they do have the equity in their home, the PMI will fall off. FHA is backed by the government, meaning an investor that executes a FHA mortgage in case of default will be paid in full with the insurance of the government. So that is why typically borrowers can have lower credit scores. In some cases, can go all the way down to a 580 as long as there are down payments. So for FHA, if you are considering, or for someone that's considering an FHA mortgage, it is for those that are typically entering into the real estate investment world. It is typically used just for your primary residences. You can purchase multifamily homes, so you can what they call house hack. I know it's very trendy on TikTok right now with an FHA loan, and think of it for lower down payment, lower credit score, less of a qualified borrower. USDA is a federally backed loan product that was created by the government to stimulate growth outside of the city. The biggest features are that it's zero down, so no down payment is required. If you're considering using a USDA loan product, the first thing to do is go ahead and check two things. Number one, make sure that the location that you are looking in is qualified to utilize the USDA loan product. And then number two, there are very specific income guidelines. And this is very strict in that it is the household income. So for example, if your wife is not on the loan, but does reside in the house with you, we are going to look at the total income of the household, not just of the loan applicant. So that is a very clear thing that you need to look out for right away. There are credit qualifying guidelines. So you do have to have a minimum credit score of 620, and there are very strict debt to income ratios. So it is very important for anyone that's thinking of utilizing a USDA loan to ensure that they want to live in a USDA eligible area, make sure that they are qualified as far as the income guidelines, and work with a lender that has experience with USDA loans like Clear Mortgage so that you can ensure you have a loan that will pass all of those requirements. The VA loan product was created by the government and the Veterans Administration as a thank you for those who have served our country. If you do have VA eligibility and you've earned that, make sure that you check that first through a certificate of eligibility that a lender can pull from the Department of Veterans Affairs directly for you. And if you do not have your certificate of eligibility, you can also pull that from your DD 214. So work with a lender that can get that for you. Once you determine that you have that eligibility, it is an amazing product that requires zero down payment, very aggressive interest rates, and is considered one of the top tier lending products because of the fact that there is no standard loan cap. The VA does have loan limits, but there are very aggressive jumbo or high balance loans that are super accessible in some of those areas that are trending to a higher price point. There are minimum credit score requirements, and ideally you would be above a 620 on your credit score. However, there are some exceptions to that, so don't disqualify yourself immediately until you talk to a lender about that. And then really the only downfall with a VA loan is that the government is responsible for choosing the appraiser. So the appraiser isn't based on a relationship with a lender, which is why sometimes you hear that sellers are not willing or are not looking at accepting VA loans because they're worried about an appraiser that isn't experienced for an area coming in and performing that appraisal and not knowing the true value of a specific area. So work with a real estate agent that is qualified to leverage and negotiate with a VA loan. And we think, and personally I think, it is one of the top products because it's zero down. There is no PMI, so there's technically no penalty to the borrower for using a lower down payment loan product. The guarantee to the investors is truly 100% from the VA, which is amazing for the borrower. So aggressive interest rates, low monthly payments, and low down payment. It's an amazing loan product for those that have served.